Good day, my name is Papa. Today I am going to do financial reports and the purpose is why these reports are necessary for emerging businesses. In order to achieve the main purpose of the module of today, I have developed a coverage of 5 topics. 1, I want us to go through the foreword. In the foreword, we're trying to give you an overview and a context in which the financial reports in an emerging businesses have to be understood. Secondly, why do entrepreneurs need these financial reports? Thirdly, I want to go through with you a number of necessary, very important, this is necessary financial reports which an entrepreneur or emerging businesses will have to use for their day-to-day management of their businesses. To give a sense of comfort, we have developed a number of examples and formats in which an entrepreneur student going through the module will develop a sense of comfort. Fifth, which is last, there will be a number of questions based on which you will be assessed on how much knowledge have you appreciated through the modules that you have gone through. Let's start with the foreword. In the foreword, I want to emphasize a number of points so that there is no confusion or lack of clarity of how these financial reports fit into your business. First, I wish to put your attention that the module is presented in a context of financial reports as a tool to run your business as an entrepreneur. However, we are not presenting in a context of annual financial statements that are used from time to time for purpose of reporting the performance of the business. So it is very key for you to have an appreciation at this level that we are presenting for purpose of business tools that are used for day-to-day management of your business. Secondly, we encourage you to learn this module in sequence with a module that covers financial analysis, because together they give a very comprehensive view of how the financial reports could be used best in the management of small businesses or emerging businesses. Thirdly, the intention of the module is to indulge you with practical financial tools. So you'll begin to go through areas or learning experiences that will directly assist in the management or challenges in the management of your businesses from financial point of view. Why do entrepreneurs need financial reports? Entrepreneurs need financial reports for the following 3 reasons, main reasons. 1, financial reports are tools from which financial performance and analysis of the business is based. Secondly, financial reports provide a basis to an entrepreneur, a continuous and a proactive management of the business. What we're talking about here, we're talking about an environment where financial reports give an entrepreneur a privilege of mitigating against the unexpected, of mitigating against the shocks. You will have a privilege here if you go through your financial reports and a better appreciation of those, that you will eliminate any surprises in your business. Thirdly, especially in cases where entrepreneurs will work as partnerships, where they will work as group of directors and so forth, It ensures that there is transparency and accountability. This is important because you will from time to time experience a situation where more than one entrepreneur working in one entity as a grouping, either as directors or as partners, etc., will be eliminated to a point where there is very minimal misunderstandings or minimal differences of personalities within the business. Let's look at the financial reports that are commonly used in business. But before we do that, as a point of emphasis, let's look at the difference, the main difference between financial reports, or what we refer as financial reports, and what we refer as annual financial statements. The difference in the main are four. One, in terms of form, they look similar. They are all based in accounting standards. Secondly, the main difference between the two is the timing and purpose. You must have, or you will appreciate, that annual financial statement, by virtue of descriptions, are those that we produce once in a year. However, comparatively to financial reports are those that we are allowed to issue from time to time and within a short space of time. Hence, they provide a privilege of mitigating against the unexpected or the surprises. Thirdly, financial reports are used in the main for internal management purposes, while annual financial statement will by its nature involve the general public. So, with the annual financial reports, you have got an obligation as required by, among other things, the Companies Act of South Africa to provide a public view on the results of your company performance. However, for financial reports, you are not obligated to the point. It's just, or it's a mere tool that should be used inside the business by management. Fourthly, therefore, based on the analogy in bullet number 3, you will begin to accept and appreciate the fact that reports are therefore a necessary or a critical management tool for an entrepreneur. What are those common types of financial reports we have been referring to? There are 6 main reports that are used by management or by entrepreneurs for internal use. 1 is profit and loss statement. 2, it's a receipt and payment report. 3, it's assets and liabilities report. And the other 3, which will be covered in the next modules of working capital, which you don't see in front of you, will be the debtors report, will be the creditors report, and the stock report. However, I would like us to focus on the first 3. First, the profit and loss report. What is profit and loss report? The profit and loss report, it's a report that indicates the performance of the business in terms of profit or a loss. It is a report that will from time to time show you whether your business is making a profit or loss, or it will be a report that will show you from time to time that the decisions that you make as an entrepreneur, they result into profitability or losses for the business. Secondly, profit and loss report is the report that shows you all the revenue or sales and expenses that should be included whether the company or the business has made a profit or loss. Thirdly, the profit and loss report shows how profitable the firm is. In instances where the profit and loss report shows a positive, we interpret that to suggest that your business is making money. What does it mean that a profit and loss report is showing a positive? It means the money that the business is generating is more than the money that the business is incurring in the form of expenses. What it means, if your sales are higher than your expenses, it means you are in a positive profit, or it means your business is making money. The negative. The negative is an opposite of the positive, where your business is losing money. Your business will be losing money where you spend more than you receive in a business. If your expenses are more than the revenue, the sales, or the income that you receive in a business, we classify that as negative performance, or a business that is losing money. Now, let me show you the format on how a profit and loss report will, under normal circumstances, look like. First, you will see the sales that we were talking about. Secondly, you will see the profit. In this case, it will be a gross profit. Thirdly, you will see expenses, all expenses that the business has incurred, starting with your bank charges, with your depreciation, with any discount that the business is allowed, marketing, membership, networks, office expenses, office maintenance, payroll expenses, petrol and oil, printing expenses, professional fees, rent, telephone, and vehicle expenses. All these expenses combined or added together, you will see they come up to a amount which is called total expenses. Now, having gone through all your expenses that the company has incurred, you now have to look at those expenses against the sales that the company has generated. In this instance, you'll see the company has generated the sales of 90,808, and at the same time you will see the company has incurred expenses of 87,789. Clearly, at that point, you can see that the expenses that the company has incurred are actually less than the sales that the company has generated. Or alternatively, you can look it from the top. You could say the sales that the company has generated are actually more than the expenses that the company has incurred. Then what does that mean? That means the company is making a profit. That means a company is in a positive performance as far as the profits of a company are concerned. And you can see that will happen from one month to the other. You can see in the month of February, the company has raised sales of 197,313, and you can see that those sales are also more than the expenses that the company has incurred. Now, I want you to pay close attention to the beauty to you as an entrepreneur of the financial reports. One, the shorter space in which you are able to look at this. Now you can see that you have looked at one performance in January. Already you will have looked at another performance within 2 months time, which is February. So therefore, the privilege that we highlighted in our introduction of the importance of financial reports, which is a shorter reporting period, there it is glaring in front of you. You can clearly see that already in 2 months time, between January and February, you as an entrepreneur, you'll be able to have a comfort of whether your business is making a profit or not. That's a beauty of financial reports. This, just as a point of emphasis, again, you compare the same to the requirements of annual financial report. That will mean, in this instance, you will have seen this performance at the end of the year. That means you will have seen it 12 months after the end of the year. What does it mean to you as an entrepreneur? That means you are losing the privilege of proactively and continuously monitoring the performance of your business. Because at the end of the 12 months, you'll agree with me, it's already late for you as an entrepreneur to implement any corrective actions that may require your attention. Let me show you in March 2016 what's happening in this business. Now, remember, for January and February, the performance of this company shows that for month January 2016, your business is making a profit, which is positive performance, which is good news for a business. For month 2, which is February 2016, the same pattern is continuing. There we are. We have made a positive performance, which is good news for a company. Now, I want you to look at March 2016. Now, when you look at March 2016, you see the opposite of what has happened in the previous 2 months. Let's look at your sales. Your sales is 188,000 rand. And your expenses for the same period is 80,323 rands. Clearly at the point, you can see that you are actually incurring more expenses than you are generating the income. Short and simple, it means your sales are less than your expenses. When we had previously said it should be the other way around for you to report good news. It should be sales higher or more than the expenses. The fact that for March 2016 you have got the opposite, you have experienced the opposite where your expenses are actually more than your sales, there you are with a negative sign. That negative sign, it means now you are not reporting a profit, you are actually reporting a loss. Now, for March 2016, you are not doing good for the business. The business is not doing well. Again, the point that I've meant to emphasize, and I wish to emphasize it again, the timing period. The fact that all these results you are seeing in a short space of time. That means in your 3rd month, you are able or you are provided with an opportunity to react. You are provided with an opportunity to see what's wrong with this company. Why you haven't made the sales that are enough for you to cover the expenses for the month. Why are your sales 34,000 rand when in the previous year month was 197? That's opportunity. That is an opportunity that the report is providing you. you are able to proactively, or you are able to react quicker. Secondly, you could ask yourself another question. Why are you incurring more money than you have? Again, because you're asking that question within a short space of time, it means the likelihood of your business avoiding any mistakes that you will have made in March 2016 are very high, which is a good thing for your business. Now that you have seen how a profit or loss come into being into your business, the next question that you have to ask yourself, as a lot of entrepreneurs would, based on the notion that cash is king, is where will those profits or losses go to? Question is that where are those profits? Many a times you hear people ask you that I have, based on the financial reports, reported a profit. However, the same amount of profit that I have reported in my profit and loss report, I cannot see it in my bank account. Critical question. Why can't you see your profit as is in your bank account? One, which is a response to your question, is you got to be careful, extremely careful, that a profit is not cash. A profit is an indicator that are you likely to have more money into your business in your bank account or lesser money in your account. So your profit is not cash in your bank account, especially if you make sales on credit or you incur expenses on credit. When I say you incur expenses on credit, I mean you are afforded credit lines by your suppliers where they allow you to collect goods and pay them later. Once you are in that situation where you sell on credit or you buy on credit, you will have to be careful that your profit is not cash. Though a profit or loss is a very critical indicator, cash, how you able to track into your business is through what is called a receipts and payment report. Some people call it a cash book. However, for all intents and purposes, I like us to refer it to receipts and payment. Receipts and payments is different from cash flow statement. A cash flow statement, it shows you the position. It shows you how much you have in your bank account. However, a receipt and payment, it shows you how are you performing in terms of your money that you receive or the money that you pay. It also differs with a profit and loss report because in a profit and loss report, you show in transactions that you still have to either receive money for or you still have to pay for, when the receipt is the money that you have actually paid for or the money that you have actually received. That's a very critical difference between the three. The three, which is your profit and loss, which is a cash flow and a cash receipt and payment report. Then you will move with me from that point that a cash receipt and a payment is the actual money that comes into your business or the actual money that goes out of your business in terms of hard cash And for you to be able to have a successful management of those, you need to observe those in your receipts and payments report. The last one is the assets and liabilities report. Others, they call it a balance sheet. Others call it a personal statement of assets and liabilities. For all intents and purposes, I would like us to refer it to as assets and liabilities report. What is an asset and a liabilities report? An asset and liabilities report, it's a report that shows the net worth of the company. Be reminded that in your profit and loss report, you are showing performance. In your cash and receipts report, you are showing the performance of cash. Combine, the two combined, they could either translate into a bankruptcy of the company, or it could translate to the positive net worth of the company. It could translate into the bankruptcy of the company because, one, you will have incurred bigger liabilities, which is, for practical examples, you will incur or go borrow money for you to buy machinery. You will be sitting with the money or loan that you owe to the funder. That money that you owe to the funder was meant to procure a machinery that will be used for a specific purpose. If that machinery is not able to achieve what you intended of it, you are likely to show a negative into your assets and liabilities. That will suggest you have got more debts than you have assets. You'll have more debts because your machinery is not producing what is required. Example, if you borrow from ABSA 100,000 for purpose of buying a machinery, that a machinery will be used to produce goods. Those goods will have to be sold out in the market for a certain price that will make a profit, and that profit should translate either into good cash or negative cash. Should that machinery not achieve the whole that it was supposed to achieve, it will then bring you losses. And those losses, in addition to what you already owe to ABSA when it's compared to the assets that you have in the form of machinery, it will bring you to a situation where you have got more liabilities and lesser assets. Once you have got more liabilities than the assets, you are likely, or you already are, declared bankrupt as a business. However, the situation that we would like to have is to have a situation where your assets are higher or bigger than your liabilities. That means when you have got the same loan of 100,000 that you have borrowed from ABSA to buy a machine, from that machine you are able to produce a product that you sell at a profit to the market, and the market is buying the product. You will be reporting a profit. By virtue of reporting a profit, you will likely to have more cash in your account of your business. Having more cash into your business, now you are actually now reversing the opposite of the first example, wherein now you will be sitting with a machine which will be showing as an asset. In addition to that machine, you'll be sitting with positive cash. Once you have got positive cash in your bank account, that means you have got an asset. And that asset added together with your machine will now translate in you having lesser liabilities, and the likelihood of your liabilities or the loan that you'll be owing of 100,000 going down will be higher because now you have got more cash to pay off that loan. Now, with your loans being lower than the assets that you will have in the form of cash and the machinery, you are classified as a, or your business is classified as having a positive worth, which is your business is worth. The items that will show in your assets and liabilities report are as follows. 1. You will have the assets that will last for a long period in a business. The assets that will last for a long period in a business. Long period here we refer to a period that goes beyond a year. Those assets will be classified as non-current or long-term assets. Example of those assets will be your land. As we know, a land, it lives forever. You will have buildings. We know buildings live for a longer period of time. You will have machinery that also lives for a longer period of time. The next item that you will be seeing in your assets and liabilities report is the assets. But these are the assets that do not last for long. These are the assets that last for a short space of time. A short space of time in this case we refer to a period of less than a year. For example, we all know that once you have got cash into your business, that cash, it's highly volatile. It moves very quick. The fact that it moves very quick, we classify that as current assets because it doesn't last for over a period of time. The other examples of current assets will be your stock in your business. As we know, stock doesn't stay for a long period in your business as a result of the fact that it doesn't stay or it moves very fast in a short space of time. We will look at that as a current asset. People that owe you money, we all know that we get into credit arrangements with our customers. From those credit arrangements, you will have, on average, customers say, I borrow money from you in the form of you providing me with goods or you providing me with a service, and I will pay you after that service or product has been received. In the fact that they will promise to pay back the money that they owe you, in most instances you'll have customers that says we'll pay you within 30 days. The fact that the 30 days is shorter than a year, that suggests that you are collecting your money within a short space of time. As such, therefore, people who owe you money will be classified as current assets. Thirdly, you will have liabilities. Similar as assets, you have got long-term liabilities and current liabilities. Long-term liabilities and current liabilities operates or work on the same principle, that the other lasts for a period longer than a year and the other lasts for a period shorter than a year. Let's speak about long-term liabilities. For example, these will be loans. Where you go into a loan and the funder provides you with a privilege of repaying that money for example, 3 years. For fact that the funder says you can pay off this money for a period of 3 years, that we classify as a long-term loan because it's over a year that you have to pay back that loan. In an instance where the funder says, I will borrow you money as a business, but I need you to pay me before the end of 12 months, that is classified as short-term loan. Examples will be where you go on overdraft facility with your funder, that will be classified as such. Another example of current liabilities is where you buy stock from your supplier and you come back and say to your supplier, I will pay you back the stock that I have bought for you from you at the end of the month. So what you are saying to your supplier, I will pay you before the 30 days period expires. Therefore, you are committing yourself to a short-term liability, which in the main will be the difference between a long-term and a short-term liability. Now, I want you to have a look on a format of a asset and liability report. In this instance, you can see that a company has got assets of 15,000 rands. Of the assets of 15,000 rands, you can see the company owes other people 4,000 rands. Now, what I want you to look at is the 11,000 difference. Once the difference shows a positive, in this sense a positive, it's, as I mentioned previously, assets that are more than liabilities, or assets that are more than the money the business owes other people. Once you are in that situation, it means you are in a positive situation, and that positive situation, for a lack of a better word, it will translate itself to what is known as equity, and this will show you as positive equity. Once you are in positive equity, that means you are in a positive worth. That means the performance of your business from profit point of view, that means performance of your business from cash point of view, combined together, it increases your worth. It increases how much wealthy the business is becoming, and that wealth will be demonstrated by what's called an equity. As you can see in this case, that the business was able to generate an equity of 11,000, and for any business, this is what we all should strive for. Should the opposite happen, you will see a positive, so you will see a negative reflection on your assets and liabilities report, and that negative reflection is what's called bankruptcy. That means your business is bankrupt. With all that, I wish to thank you for your time, especially your focus on how profitability, on how cash could translate into a positive worth or a bankruptcy of the company. And from here, I wish to invite you to take the 10 questions that we had spoken about earlier in our introduction and see how your appreciation and understanding of the topics, the 3 topics that we have covered in this module. Thank you.